now. Okay, we're recording now. So 5 little known facts about FHA financing, ways that you can help more clients and sell more homes. Jordan Syers on our virtual mortgage partners team is kind of like our guideline and scenario Jedi. And I thought, Jordan, maybe the best place to start would be the fact that earlier this week, you let the team know that you had just pre-approved a buyer with an FHA buyer with a 513 credit score. Because I think that illustrates little known fact number 1, which is, Jordan, credit score minimum.
Credit score minimums are 500 on FHA loans. I know we talked about this in our last session, but most banks have overlays, across the board, and those overlays have usually the minimum of most banks is about a 580, right? But technically, from an FHA standpoint, FHA guideline standpoint, there are banks out there that go down to a 500 credit score. Now, the caveat on a 500 credit score is it has to have 10% down. Anything between 500 and 580 is 10% down.
So 10% down. And, one of the benefits of our mortgage team is we have access to over 200 lenders. So when Jordan talks about overlays, if you go to your local bank or lender, and you've got an FHA buyer, they may have an overlay that requires them to be at a 620, maybe down to 600 or 580. We have, Jordan, do you have any idea how many lenders we have that'll go down to 500?
6.
So we have 6 lenders that will go down to a 500, again, with 10% down. 10% down, right? That's the caveat. But as I said, Jordan, earlier this week, was able to pre-approve a buyer, FHA financing with a 513 credit score. So, there is, if they are willing and have the means, there are oftentimes ways to help clients where they may have been turned down by other lenders. We've been helping and working with clients that have been turned down by 1, 2, 3, up to 6 different lenders have turned them down. We've been able to get folks pre-approved, under contract, and closed on, in some cases, multiple properties even. So that's kind of little known fact number 1. Now, Jordan mentioned briefly, little nugget in there, that last week's session, we talked about overlays. Last week's session was on VA loans. I will find the replay link of that and I'll put it in the chat. And if I'm sending this to you after, I'll include that as well, because that was a great session. We had great questions. And we were talking about how you can use the VA loan program to build an investment portfolio, but we also got into a lot of other particulars about the VA loan program and how that works and some of the qualifications and misconceptions around that. Okay, so that's little known fact number 1. FHA, people can qualify down to a 500 credit score. Jordan, where should we go next with these sort of little known facts about FHA?
You can have multiple FHA home loans. Yeah, so there are a lot of caveats with this one. Okay, so there are caveats with them with this one. There are situations where people can have more than one. A lot of it is usually based on family, like maybe family size. Yeah, maybe you're moving and you want a bigger house because you're having a baby, as one reason. Just like or maybe your house is just getting bigger. Maybe you just need more room, right? You need more bedrooms or whatever the case is. There's also where if you're moving for a job long distances, right? Maybe it's a job that you got a job offer in Washington and you live in Florida, right? That's another situation where you could have more than one FHA home loan. There are caveats in the terms of how much equity position you need to have, especially if it's under 100 miles. It's usually a 25% equity position in your current house. So you actually have to order 2 appraisals on FHA when you're doing that. So you have to order your first appraisal, which is on their current home, and it has to have at least a 25% equity position if you're within a 100-mile radius. And then you'll order your normal appraisal and your normal purchase. I did this recently, I want to say 2 months ago, with a guy named Andrew Gallagher. His wife was pregnant again. They had limited number of bedrooms and they wanted to move up. He had the equity position, because most people do right now. They don't want to refinance their house. They want to keep it. Why would you want to refinance an FHA loan at 2% interest rate? But they think they can't get another FHA, but they might have another, an equity position of at least 25%. They could turn around, buy another house, as long as it has an acceptable reason.
Which also ties into last week's, so one of the misconceptions about VA was that you can have multiple VA loans. Again, there has to be a good reason. But if you have that reason, the legitimate reason, you can have multiple. There are some other strategies with that, which you can explore individually with Jordan if you'd like. I have put Jordan's contact information there, but there are some other ways that you can navigate that.
The most I've ever had a client buy was eight FHAs. So you cap out.
But 8 houses with 8 FHA financing, meaning had owned all 8, with FHA financing.
Mm-hmm.
Yeah.
So there's ways. There's never breaking the rules. There's just always working around the rules. So when you know the guidelines, you can work around the guidelines a little bit.
Navigating the guidelines. The guidelines. Yep. The guidelines are there, but there's always, or there are oftentimes workarounds to them. Okay. So we've got 500 minimum credit score. We've got the possibility of multiple FHA loans. What should we cover next on our
investment properties? Or we can. I especially for a first-time home buyer, I don't know if anyone's ever helped someone buy a quadplex or a duplex before. But typically, if you try to go conventional on those, even if you're living in one side, the minimum down payment's 15% on conventional. With FHA, it's 3.5 no matter what, all the way up to a 4-unit. Okay. Your loan amount minimums in your area. So, I'm sure people know that there's FHA maximum loan amounts, right? The number of units, each unit that you're buying increases. So when you're buying a 4-unit, it's like a $1.5 million. It's not 400,000. The number of units, it scales up with the number of units. So some people think, oh, I can't buy that duplex because it's 700 grand. It doesn't qualify for FHA because my maximum loan amount is 400,000. It actually increases with the number of units you have. So if it's a 4-unit property, you can look up in your county. There is a website you can look it up for, county limits. You just put in your county there, and it'll give you 1 unit, 2 unit, 3 unit, 4 units, and the maximums for that county or that zip code. And I could put that in the chat so you guys, if you want to look it up, if you run across it. But 9 times out of 10, you're not going to find a property that it's based off the area of the median cost area for that, for that area. So if you're looking in LA, it's millions of dollars. If you're looking in Pennsylvania, it's $1 million, yeah. So it just depends. Someone talking?
I got it.
Okay. So with that being said, though, it's only 3.5% down. So when you're talking to someone wanting to get into investing, right? And I said this last week, and I said it on a call today. I'm a huge advocate for people dipping their toes in the water on investing, because it lines you up for multiple purchases, right? It gets you going. So if you can get the first couple, at least the first couple with minimal money down, it gets them going, gets them some cash flow going to where they can buy more properties with different mortgage products later on. So FHA is one of those products. You can buy a quadplex with minimum money down, 3.5%. You can even use the rent. So let's say that the other 3 sides are rented at $1,000 a month. You can use it at 75% of the rent value. So if you can add basically $750 in income to offset that payment. So that client that thinks they can't qualify, well, a lot of times it offsets and negates their payment so much they don't actually even make a payment.
So hold on. I'm going to unpack several things here. Yeah. So let's say it's a quadplex, and each of the other 3 units are renting for a total of $3,000, $1,000 each. That's $3,000. You can take that by 75, which would be $21,250, right?
Yeah.
250, right? Which then can be counted towards their income on their DTI.
Correct.
Okay. So I'm just highlighting that for everybody, right? So that's another.
Let me explain this way. I've had Social Security borrowers be able to buy houses in the $300,000-$400,000 range because those rents offset it, and it put them in a position to where they didn't have to make a mortgage payment as long as they kept those rented. So it put them in a better position.
Some light bulbs are going off for folks. I hope. Hopefully, you can see how this one of the five, this one alone, can vary. Like can without question help you help more motivated, ready, willing, and able buyers. Right? You can show them a path, not just to purchase their first property, but to get started as a real estate investor at the same time. So to solve their own, property needs, and also start growing well.
It also puts them in a position to where, if you think about it this way, let's say your market is a market where an average single family is 250,000, right? And they qualify for 175,000. This would also put them in a position, as long as those other three sides units are rented out, that it gets them in the game.
Yeah.
Like that's part of our problem right now, is getting the clients even in the game to purchase houses. Yeah. So looking at the box and saying, okay, how can we get this client to get into find a duplex in the $300,000-$400,000 range, or a quadplex, but how do I get them to qualify? We have that on, I'm using an example from last week, but we're doing that with a VA loan right now, where someone did not quite qualify on their own to buy single family because they couldn't find anything. They couldn't find anything at 175,000 in that area, but they're able to find a triplex that they could live in one side, and purchase it that way, and they use the rents to help their income.
Two more things on this front. I had a phone call yesterday with Chris Pataki, an agent in Delaware. He was calling, asking, what's the minimum down payment for for a mortgage on an investment property. And so we explored that, and we do have DSCR loans that will do up to 85% LTV if the investor is experienced, et cetera. And I said, the conversation you really need to have with this person, because I asked, are they an experienced investor? And he said, no. Not only that, they've never purchased a property. I said, listen, the conversation you need to have then is, we're going to buy your first investment property, but you're living in one of the units. Live in one of the units for a year. You can use FHA financing, live in it for a year, and then we can explore, do we have a legitimate reason to then go and buy
a different one,
a single family, or you buy a triplex or a quadplex, and then you can buy a duplex, right? Yeah. So that you can strategically be growing your investment portfolio with a great financing option here. The second thing I wanted to bring up, and this is more of a question for me from me. Down payment assistance. Can they use down payment assistance and buy a multifamily?
Yes.
So theoretically, potentially.
There's also one other thing I want to mention. It's one of our other key things. It's a little bit more difficult, but yes, and the answer is yes on that. The answer is yes on that because of minimum down and down payment assistance. But there is another kind of caveat, is if it's a HUD home, it's $100. You can do $100 down, and it's not down payment assistance. It kind of gets us to the next one. Four. That'd be number four.
So hold on. Let me backtrack for a second here. So down payment assistance means theoretically could get 100% financing. Okay, theoretically, but it's got there are other qualifications to that. But these are conversation starting points you can have with folks to get them, to get them motivated, excited, et cetera. And then we can fill in the gaps and have those more strategic conversations, or to walk them through the guidelines and scenarios, et cetera. One thing, Daphne Anderson said he should stay 2 years as primary to get away from capital gains. Well, we're not
selling it. They're not selling the property.
We're holding on to the assets. Yeah.
So there wouldn't be no capital gains there.
Yeah. I mean, you would only worry about capital gains if you're selling. And even then, you could theoretically 1031. There are other options, et cetera. The DPA criteria George is asking.
So there are DPA. Okay, let me explain this again because I had to explain this on the last call. I'm gonna explain the difference between a manual underwrite and a AUS underwriting. Okay, we call it AUS. It's called automated underwriting system. 99.9% of underwriters want to get an AUS approve eligible. That's what you'll hear that term a lot. And
because they're lazy.
Yes, well, one, they're lazy, but two, it's more of a guarantee, right? I am more confident if I'm giving Michelle, for example, a pre-approval letter if I have an AUS accept, right? But if I have a manual underwrite, it's basically me saying, hey, I know the system is saying no, but I know my guidelines well enough that I'm overriding the system. Okay. So DPA criteria technically, George, goes down to 500. There isn't, as long as they qualify for an FHA loan and that lender does not have an overlay for their DPA program, which I know of one that we do have, goes down to 500. The normal you're going to see though is about 580. 90% of lenders are going to go down to about a 580. For an AUS accept, you're going to see maybe about a 640, right? We want to see them have a 640 with DPA. And good ratios. But with a 640, if I wasn't getting the AUS accept and I had a 640 and I had great ratios and I was at my job for over 2 years and it's, a stable job, maybe it's salary, I would take that a manual underwrite all day long. I would not ever turn down that loan. I would. And how we do manuals, we do them a little different. I have a rule on my team that we do a TBD underwrite. If you guys don't know what a TBD underwrite is, it's a to be determined underwrite. Think about doing the entire mortgage process backwards. So instead of them going out and finding a house first, then going through the entire process, right? Which is the norm. Normally we do a 45-minute pre-approval, run them through all the systems we have, check their documents, and then we give you a pre-approval letter and you go out and run houses. There is something called TBD underwriting, which is basically we submit without a house to a lender. They do a full approval underwrite and they will underwrite your loan completely. So I'm actually submitting one of those today for FHA. It's a $500,000 house in Oklahoma. Okay. They are buyers with an L1A, which if you guys don't know what an L1A, it's a visa. It's a work visa, an executive visa. So he's a president of a company, but he has a very lack of credit history. His daughter has no credit score and he has a 627 because he just started his credit 8 months ago, 9 months ago. So where do you take that, right? You can't go conventional on those. We can go a manual underwrite because the guy makes, $500,000 a year salary. His ratios are like 10%. And the only downside is that his daughter has no score and he has a 627. Okay. That's the only thing wrong with the file. Josh, go ahead.
So I want to take a minute here.
Go ahead. Sorry.
If your eyes glaze over, hold on. If your eyes glaze over when Jordan gets into the weeds here, please understand, you don't need to know the weeds. The idea of these sessions are we're giving you we're trying to open your eyes, big picture, to 5 different opportunities or ways that you may not be aware of. And if you can open or create the conversation opportunity, Jordan or someone on our team can then walk through the more specific particulars for that client. What you should not try to do is understand all of this to the level that Jordan does. You just have to know it well enough to know that this is possible. I can't guarantee that you're going to qualify, but let's find out together. Let's get with Jordan or one of our production managers or, whatever the case may be, to explore what of these opportunities or options you may or may be a fit for you, right?
Oh.
So like Jordan gets excited.
Yeah, I know. I do.
Say,
sorry.
even on half of what he just said to me was like,
yeah, I know. I do that a little too much. But with that being said, just to kind of answer George's question is, if we have to do a manual underwrite, we'll submit it. We'll do the loan backwards. We'll basically get a full approval all the way through underwriting and give Michelle a full approval letter, not a pre-approval letter. On those. So if I'm overriding our system, which we do which I do more often than not, you know, lately, it seems like. But essentially there are scenarios there that we can do.
One thing I want to emphasize with this, that what Jordan is describing, AUS versus manual underwrite, is also why we're working with a lot of clients that had been turned down by other lenders, because they were turned down by the AUS. And the other lender didn't want to, or didn't have the knowledge to be able to put together how you could do the manual underwrite. And this is another huge benefit of Jordan and our team. Almost on a regular basis, we have loan scenarios where we're stuck, and Jordan's like, do this, 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 and this, and we're good, right? Like, call this FHA helpline, tell them this, submit this thing, and we're good to go, right? So that's part of his Jedi skills when it comes to this. All right, we have two more, and then I want to make sure that we have time for Q&A for everybody here. So you started to mention this. Let's double back on the $100 down HUD homes.
Yeah, who would here like to buy a house for $100? So if you buy a HUD home, so if you go to, you know, there's a lot of websites on there that sell this, you know, sell the information, but there is HUD.gov, right, that list homes. Bigger areas, like larger metropolitan areas, will have more HUD homes. But if you can and win the bid, you know, whatever the bid is for the client, FHA allows you, if you buy an FHA foreclosed home, a HUD home, you can buy that HUD home for $100 down. So that is part of the program. It's same. Everything else is the same. The only difference is there is a little bit of challenge with agents sometimes, because they got to turn on utilities. You got to have certain utilities turned on before the appraiser goes out there. So there is a little bit of working with the lender, with us, on when we order the appraisal, because we basically will stall on the appraisal until you have your, you know, you get all your forms submitted for the utilities to turn on. But I have had clients buy where they've had closing costs paid by HUD, and then they literally come to the table with $100. Exactly.
Yep. I will say also, I've had, this isn't the topic for today, this will be another info session, but I've done USDA where I represented the buyer. We got 6% seller help, and literally the out of pocket for the buyer was the appraisal, and they got a home inspection.
Yeah.
That was literally their out of pocket, less than first and last month's rent if they were renting the same house. So, you know,
turning away someone because they don't have money is not a good idea ever. Ever. There's usually a way to do it as long as they fit the rest of the box. I go back to this all the time with my agents, and I talk about this a lot because I want you guys all thinking this way. 3 pillars: credit, income, assets. If they're missing one of them, they're missing assets, and they have good credit and good income, we're golden. It's good. You can always have 2 pillars and we'll be okay. So that's a DPA program, that's USDA, that's $100 HUD down. There's something. It's just a matter of whether or not on putting them on the right list and working with your lender on what that right list would be. It might be that I have a client that doesn't qualify for USDA, doesn't qualify for DPA, but they qualify for the $100 down HUD program. So you might have put them on a search for only HUD foreclosures, for example. It's getting them in the right realm, fitting in the right product with them, and getting you out, being able to show them a house, you know, that actually works, and instead of just turning people away.
Now, it's not always, especially in our current market conditions, let's face it, it's not always easy to find a home that will fit here. But here's what I can tell you, and Jordan and I have lots of experience with this. When you go the extra mile for these clients, they become your biggest fans and advocates. They will go out of their way to try and give you more business, because most other people, agents and mortgage, are they've been turned away. That example that I gave, the most recent example that I have of helping clients, USDA seller help, their total out-of-pocket cost was less than $1,000. They had been working with an agent previously that gave up, and had a lender that was like, had told them you have to wait another 6 or 9 months or something like that. I don't even remember at this point. And now they are like one of my biggest advocates. And so it's, anyway, that's an aside to the 5 little known facts here. Number 5. And I think this relates to what, Rich, you were talking about. Little known facts apply to FHA rebuilds. I think you're talking about the FHA 203K, which was number 5 on our list here. Can you unpack that a little bit, Jordan?
So a lot of I'll give a little bit of background on me on this one, because I actually specialized in 203Ks in the beginning of my career.
And just so you know, Jordan's been doing mortgages since he was 12. If you
I know. Yeah. About 11 years, 10 years. But with that being said, well, when I went to my mentor, the person I trained she was a head underwriter for 20 years. She made me read all the manuals multiple times, FHA manuals, and she would like literally quiz me. She'd be like, "Hey, you got to pass tests on your mortgage guidelines." And to this day, I'm thankful. And it's a hard read. It's like reading law, right? It's kind of a hard read. And they're about 2,000 or 3,000 pages each. But she made me do that over and over again for my first couple years. And then on top of it, I asked her, what is the hardest? I want to break into the market. I was 19 years old, I think at the time, 19, 20. And I already have a baby face. So I looked even younger. So for me, I had to prove my worth, right? More than anything. And so I said, I want to do the hardest product I could possibly do in the market and figure out how to do that product. That's an FHA 203K. It is a difficult product for a loan originator to do. Not necessarily on the real estate side. It is difficult to know the caveats and the nuances of the FHA 203K. I did about 6 to 7 a month for a couple years, and it is extremely difficult. But if you know what you're doing, you can easily help out clients with this. You can remodel houses. You can buy distressed property and remodel them. I've had clients go out and buy foreclosures and buy with FHA 203K because people don't want to touch it for whatever reason. I've had essentially just framing up and finish how people that didn't quite finish their new construction, they went in and finished it out with an FHA 203K. Now, there's a lot of options for this in terms of construction loans and the way we do it. FHA is just one of those options, right? That might not necessarily be something for them that we want to do. It might be a normal construction loan, but at least gets the conversation going of, hey, this client loves this house, loves the lot. Absolutely, wife hates the kitchen. Absolutely hates the kitchen. We'll remodel the kitchen. We'll take it, purchase the house, remodel kitchen. It's 3.5% down on the total remodel. So if it's, let's say it's a $200,000 house, they're remodeling it, for another 50 grand, you'd have 3.5% of 250,000. Anything over $30,000 in remodeling, it gets a little more difficult because you're going to have what is called a HUD consultant involved at that point. It's basically a babysitter for your contractor. Okay. That's the other thing to kind of watch out for. So I typically try to keep the remodels under $30,000 a lot of times, which is hard to do when you're remodeling a kitchen sometimes. But I advise those clients to do that because it's a much easier process. It's called an FHA 203K streamline. Yeah. It's a much easier, much faster process where when you have a HUD consultant involved, you got a babysitter that is going
more red tape.
Yeah, more red tape to jump through. Yeah. But it is a product that I've used a lot in my past, and it is for clients that absolutely love the house, but they're going to turn it away because I don't know, they don't like the living room. Have you thought about changing the living room? Have you thought about tearing out that wall? Right? As long as it's not structural, you should be able to do it. You can even add additions, by the way. You can add bedrooms. Maybe they love the house.
We've got some great questions here, but I want to just point out, how can you take this information and turn it into opportunities for you? Information like this is great to go back to your existing database, or even clients that you had, they were whether they were looking at properties online or you've been out looking at properties with them and they've gotten, you haven't heard from them in a while, or they got discouraged, or they keep losing out. This is by pointing out this information to them, you're providing or demonstrating value. And it's a way that you can re-engage or reinvigorate and get people excited again. Hey, I know we haven't been able to find a property in the price range that you're thinking, in the condition you're thinking. Maybe we should look at this FHA 203K, where we can find a property maybe for a little bit less list price, but we can make some renovations, bring it up to the condition that you have in your mind of what you want that first property to look like, and just approach this from a different angle than everybody else that's in the market with you, right? So it's having this information is valuable for you as you're having these conversations, but what you should really do is proactively use this information to re-engage with existing, post on social media. Hey, did you know that you can buy a multifamily property with as little as 0 to 3.5% down? If you'd like to learn more how, shoot me a private message, right? And you put a picture of a multifamily property or something like that. Be proactive about using this information to get you into conversations with more clients, right? That's how to practically take this and put it into application, apply the information. Rich asks, can the 203K also be used for a duplex, triplex, or quadplex, or converting a large home to an owner and rental rooms, or like things of that?
Mm-hmm.
Yep.
FHA also allows border income after 2 years. So if you're like one of the guy that I talked about that had 8 FHA loans, right? That I helped him get 8. He lived in one of those quadplexes, and once he actually grabbed the biggest side of the quadplex, and then he rented all 3 rooms out for border income. And after 2 years, we could use that income to qualify. So it added more income, even more, as long as you're okay with living with more people. But yes, the answer is yes.
Jordan mentioned where to go and find HUD homes, available HUD homes in your market. Robert, thank you for sharing the link for that. It's hudhomestore.gov, hudhomestore.gov. You can go and search. Now, listen, that may or may not be an opportunity in your market. Okay. And depending on your population density and other factors, you may or may not, but like being equipped with as much of this information as possible, so that when you're having conversations with clients of all types and sizes, having that information is better than not having it. That's for sure. Do you do loans for lots or land? I think, George, are you talking about just to purchase the lot or to purchase and build, George? And maybe that.
Okay. So this can be a little confusing, right? So how you do it, there's better ways to do it and there's worse ways to do it. If you're just trying to buy the lot and hold on to the lot for a long time kind of thing and build like in 2 or 3 years, it's a lot harder to find loans for that specifically. Because a lot of brokerages lenders don't want to go under 100 grand. If it's over 100 grand, usually you have a larger down payment. You're going to have a better time with a credit union on that. If you are looking to build on it within like a year, a new construction loan will purchase the land. You won't actually buy the lot. You'd actually get a new construction loan, purchase the lot, and build at the same time. That is a much easier process to do because it's all wrapped in one, all doing it at once. And then there's also where your builder carries it as well. So ideally, the best situation is builder carries your construction loan, and it's just a normal purchase at that point. We do them all the time. It's just usually 99% built on models or whatever reason. But you can get builders to build, their spec, another home and carry the construction loan at some sort of cost. That is usually the easiest for clients. But to answer your question, yes and no. Just depends on the situation and the price point.
Yep. Rich had actually sent this as a direct message, but it's valuable to everyone. He asked, are we licensed in a particular state? And I won't say Rich. Rich already said a state, in Oregon. So NEXA Mortgage, we're licensed in 48 out of the 50 states as a brokerage. We're not licensed in New York and Massachusetts. There's a whole bunch of reasons why. We're working on those, but who knows when they will be. It's really hard. They're a pain in the butt. Our team is licensed in, I'm losing, we're adding frequently, but there are 30, we're working towards 35 that have no distance requirements, and we're more than halfway to the 35. And then there are 13,
Oregon is
New York and Massachusetts.
Oregon is in process, by the way.
Yeah, so there you go. Oregon's in process, but in either scenario or either case, as long as you're not in New York or Massachusetts, we can help in some way, shape, or form. So don't hesitate to reach out. If you're in New York and Mass, there are, I don't know, it's not whatever. Referrals. Reach out if you have questions, but we can refer potentially. What requirements are there for a buyer to qualify for FHA 203K? I guess a better way of asking it, is it any different than
no
any
sometimes the AUS requires a little bit higher credit score, but that's about it. So about 660, 640. You gotta, it's more based off of just traditional. FHA is super simple. Like it really is. I mean, it's based off of the guidelines. What you're going to run across again on that is overlays. Most overlays see about 660. But if you Googled FHA's minimum credit score on an FHA 2 or 3K, as long as you're not going into any sponsored stuff, it'll tell you the minimum. It's usually, I think it's 580 or 620. I'd have to look it up.
And the multiple FHA loans, Isabel, Jordan, and you may have been late. There was number one would be a reason, having a reason why you bought a duplex, and you have a job relocation, or your family's growing, whatever. Like having a reason why
move.
You're moving out of that property.
I have another one: a divorce. You have a current FHA, your spouse is staying in it. Can you have another FHA loan? Absolutely. You can do that all day.
There are other more creative ways to navigate the guidelines. If you'd like to explore those, just reach out to Jordan directly. The scenario, the example that he gave with the 8, it's a little bit
unique to that person.
Around the
it's unique to that person too. So a lot of times when you're guiding someone, it's finding out what they have and what resources they have available to them. But they always, at the end of the day, they always live in it. It's still a primary residence, no matter what, for somebody.
Yep. Robert had posted this very early on, so thank you for being patient, Robert, on this. I'm interested in learning about assumable loans. As I understand it, only FHA loans can be assumed. So there's a couple of things to unpack there. It's not just FHA, and then maybe you can unpack how that works a little bit as well.
So all government loans can be assumed, right? So USDA, VA, FHA, the three, I call them 3 big ones, right? The three big boys. They can be assumed. And what in this market, assumable mortgages are even, honestly, it's great, especially to get listings, right? Or to get help people get lower interest rates. What is not great about it is they got to buy out the equity position. So whatever the equity position, they're taking over the loan. They're not refinancing that loan. So they're going direct to servicer. So this is not something you'd contact me for, right? Because I'm not the servicer on the loan. Whoever the servicer is, you go directly to that lender. And again, do they have any financial benefit on you assuming that loan, as a mortgage lender? No, there's no financial benefit. It's going to take however long it's going to take. Okay, so that's usually not problem number one with assumables. Okay, number two is where it's really, really, really lucrative is that they take over the interest rate. So if that interest rate was 2.75, that's the interest rate that they would take over. But if they had a $50,000 equity position that the seller didn't want to give up and they wanted their money for, basically you'd have to put $50,000 on an FHA loan or $50,000 on a VA loan, and you could take it over. Also, that is the only way for a non-veteran I'm not trying to get into VA right now, but a non-veteran to own a VA home loan is to assume a loan.
I'll give you a very specific example. Ryan on our mortgage team, he recently bought a house in Central PA, and it was a VA loan, and they were offering to assume it. But for several reasons, they weren't able to go that route on that situation. But if they had been, I think it was 275 or it was something, something remarkable. But to reiterate, you still have to address the equity. The seller is still going to want their equity in some way, shape, or form. So you still have to be able to address that one way or another. Bob Powell, go ahead.
Can I give him a little extra?
Yeah.
Little extra. Have you guys ever heard of a gift of equity? A gift of equity on a conventional or FHA?
I know that we've been working on several of these.
Yeah. So when you're buying from family, it's essentially 0% down and 0 closing costs. Anytime you're buying from a family, you just have to associate a family relationship, right? Some sort of blood relationship or marriage. It goes all the way to cousin. You can't do it at cousin, but aunts, uncles, grandma, grandpa, whoever it is, right? I have a client right now that has been renting from her aunt for the last 26 years, and she was trying to find a loan that she can buy this house with. Well, if we know our guidelines, which is we go down to a 500 credit score with 10% down, and she's giving them a deal, the house is worth 300,000. She was told by another lender that she couldn't do that loan, right? The house is worth 200,000. She's buying for 200 grand. Is there equity there? Yeah, about $100,000 worth of equity. So is it more than 10% down? Yes. With 10% down, we go down to 500. She has a 586 credit score. She can do 3.5% down, but she's not going to get an AUS accept at 3.5% down. But we're going to do a gift to equity for 33%. Do you think the system's going to take her with a 33% equity position? Absolutely. That'll go all day. It's like her putting 30% down on a house. So I got her pre-approved. They're writing up a contract right now. And it's just, it's one agent making both sides of the deal. They're getting paid 6%. And I was able to find a way that this client is actually putting no money out of pocket, buying the house and buying it with a credit score in the 500s. Might be something that, if we're willing to sell it to a family member, it definitely opens it up for them too. But again, at equity position, they got to be willing to give that up.
Right.
Same with assumables.
Bob, where do we get marketing materials? So Bob, and anyone wondering, number one, you can create a free account at wakeup.realestate, free account at wakeup.realestate. And there are a number of free resources, including scripts and templates, both from mortgage and financing perspective, like scripts that are specifically designed around the financing angle that you can though use as an agent and that I use as an agent. By the way, that hair club for men, I'm really dating myself, but I'm not only the president, but I'm a client or whatever. Like our mortgage team, I also use in my real estate business, right? So the templates and resources, et cetera, here are things that I use with my local database to get into more conversations and create more appointments and warm referrals for myself and my local team. There are scripts and templates. There's also lead capture pages that are around different mortgage programs. For example, there's an FHA DPA. There's one around 3 0 down financing options, and there are many others as well. And we continue to add to that library. All of that is free. You go wakeup.realestate, create a free account. And then I would also highly recommend anyone interested, go to vqualifier.com. And the link is in the chat. If you're watching this after the fact, like on replay, the link will be in the description. But vqualifier.com, there's a short video and an overview of all of the things that we're doing, the majority of which cost you nothing, to help you drastically increase your conversion rates and therefore increase your GCI. So that's that's the only plug or pitch I'll make here is stuff that really costs you nothing. But for those that are interested, you can explore in more detail. And then I'll put Jordan's contact information again. If you have any clients, I know last week that we had several folks that were live that had, situations, scenarios, potential clients that needed help. And Jordan was able to get them pointed in the right direction. Some of which ended up getting them set up for credit direction, because you can qualify with FHA down to 500, or that you can qualify for VA down to 500 or no score. Just because that is possible doesn't mean that that's going to be the best fit or an opportunity for everyone. So it may be that we have to get them set up on credit direction and help them with getting on the path to where we can get them better qualified for a better situation or scenario. So Jordan's direct contact information I'm posting again there. How about an estate sale? Would the gift of equity work on an estate sale? Stacy asked.
I haven't done one personally.
Okay.
If it's family estate, and depending on who's handling the estate, it's possible. I think it's possible. I'd have to call HUD itself. I'd have to call FHA itself and ask on that one.
Yeah, but we can find out. If you have a specific scenario, Stacy, we can certainly find out.
That's a good one. That's a good idea to do estate sales with gifts equity, though. That's a great idea.
Stacy also asked, do you normally do consultations first before having someone fill out a mortgage app? Or like, what is our normal flow? Let's say if somebody had someone that they wanted to refer to us, what does that typically look like?
Yeah. So yes, absolutely. We do a consultation with every single person, try to find out what potential pitfalls or what potential solutions we'll have. I call them exploratory questions, right? So if let's say Michelle or Cosette or Joanne or anybody sent me a client, right? One of my loan officers would reach out and they would ask a very specific set of questions. And you would be surprised about that set. Usually my first question is, are you a veteran? You'll be surprised on how many vets do not think when they served in the 1980s for 4 years that they qualified for a VA home loan or even crossed their mind. So our set of questions will kind of dictate what direction we take them in. But no matter what, we always direct them to an application because we give everyone a plan at the end of the day. No matter if they don't have the credit score, I've been giving people financial plans to save money for down payment if they needed to save money for down payment. And we always give credit direction because usually credit's the biggest holdback for most people. But we don't do credit direction the same concept. I've owned a credit repair company for a long time. We don't charge money for it. And I don't like when people go through and just dispute things. Because disputing actually disqualifies you from the mortgage. We just did a training with my team just the other day over this. But yeah, the consultation every time before they fill out a mortgage application, it is required. It has to happen.
I want to emphasize something you went over quickly there. Traditional credit repair doesn't necessarily make them more mortgage ready or mortgage eligible. So that is another thing.
Typically goes in the opposite direction.
But it's important for you to be aware. If you're having conversations with people, that may be a great way for you to have a different conversation where they say, well, for example, one of the best scripts that we have that works like gangbusters for myself and clients is, what's the one thing stopping you from buying your dream home this summer? Okay, what's the one thing stopping you? And somebody says credit, and you say, well, what about your credit is stopping you? And they say, well, my credit score is not where it needs to be. I'm in credit repair. And that is a perfect opportunity for you to step in and say, funny you should mention that. Our team can potentially qualify folks with credit scores down to 500. And what we see is that oftentimes credit repair can actually hurt your ability to get approved for a mortgage. When would you be available for a quick chat with one of our financing specialist so we can get you
Well,
on.
you just did this the other day, Josh. I
Yeah.
actually just they just did an application, and I think they'll pre-approve it on a VA home loan. You said they said, "Oh, my credit's not high enough," and it's like, "Well, VAs don't." I'm just asking because VA they did a full application off that scenario, by the way. Like I actually got an application in on them.
So I asked the question. They said credit, and they mentioned that they were doing VA, and I said, "Well, it's funny that you mentioned that because, you know, I'm not sure who you've been talking with, but that shouldn't be a limiting factor, or something like that." And anyway, it turned into an opportunity for us to help them sooner than later. They were ready to wait because of misinformation they got from another lender. They were just going to sit tight and hopefully do the work to get their credit.
When I did my consultation with them, what I found out is that lender had a minimum of a 620 credit score.
That was their overlay.
That was their overlay.
Yeah.
Their credit score was 611. So they turned them down. They turned that client down and they said, you need to get your credit score up, instead of saying, you know, or they didn't have the option, you know, they only work with that bank. So
yeah.
That's
Ellen asked, can you review how someone can buy a 5-unit as an owner occupant and how someone can buy multiple times with FHA loans? We've kind of covered the FHA loan multiple time thing, a reason, and there are other workarounds, but
5 units do not qualify for FHA.
Right.
So it's only up to 4 units, up to 4 units. 5 units, you're dipping into commercial. Right. But I do have lenders that will do DSCR loans, no income loans.
Well, that's what I was going to say. We could do a DSCR up to 8 units, I think, right?
Yeah, 5 to 8.
5 to 8, and what DSCR
more
means,
than that I know what lender you're talking about. That's one of our favorite lenders, is 5 to 8. I do have another lender that goes up to like 30 or 40 units, but yeah.
So with that DSCR, we're going to do an info session sometime this summer just on DSCR, but DSCR stands for debt service coverage ratio. On a 5 unit, or let's say an 8 unit, you've got a lot of income to count against the debt service, even if you're occupying one of the units, right? So you may need more money down. You will need more money down, but you know, if you can find a way to make that work,
it's no income bearing. Yeah, basically, you know, for self-employed people, real estate investors, they don't need to qualify off their income. It's just, again, 3 pillars. They don't need income. They need assets and credit, right? Decent.
Ellen, I saw that you sent a direct message. I'd be happy to have this open discussion here. If you're okay with that, let me know. If not, you can run that scenario by Jordan. His contact info is in here. I'm going to drop it to you directly. But if you're, you know, we're not going to share the specifics of the applicant or even where you're at, but you know, reviewing this and getting Jordan's thoughts on it might be helpful. So I know I'm putting Ellen on the spot, but let me do it this way. She has a VA applicant.
Okay.
Ratified contract at blank amount.
Okay.
With 5% closing costs, and the appraisal came back short 30,000. And this applicant's credit score is 800. So some of that, it's like one of these math problems that your kids may come home from school. You have to figure out which of these points actually is important for the math equation and which aren't. And maybe all of those are.
When you say 5% closing costs, is that you got 5% seller concessions?
I believe that's what she means. 5% seller help, closing help. Yeah.
What's the loan? What do we know the purchase price?
424.
Okay.
And the appraisal came in at 395. I'm sorry, Ellen. I mean, there's no way anyone would.
395. Appraisal came in 395. So we're short 30,000. Okay, and 5%. What's 5% of
20? 20K?
Is it 20K?
About a little more than 20 because it's 424 is the purchase price.
Okay. I'm going to tell you how I would do this. If it's a save deal and I want to save the deal, right? I'm not worried about income, because we do that, by the way. If I'm not worried about income, what I would do is I would take away the seller concessions completely, drop the seller concessions, drop my commissions down to the bare minimum, and then interest rates all relative to how much money you want to get back or pay to get that interest rate, right? So if I drop my commissions, it basically will give that money back to that client. Okay, so if my commissions are 2.75 on a file and I drop it to 1%, which is that's the max allowed on VA, by the way, that's a VA rule. I could essentially give them almost 2% back in lender concessions for closing costs. So we're off about $10,000, but asking the seller to drop it 30 grand and take away the 5%, they're losing 10,000 instead of 30,000 is probably more feasible. And then number two is whatever lender you're working with, if you can drop the rate to one, their cost to 1 point, and then give them back a couple percents on that rate to pay their closing costs for them, that client still wouldn't need any money out of pocket. I don't think you need 5% seller concessions. It depends on where you're at. I think I doubt your closing cost is $20,000. If it is, you need to shop lenders anyway.
Yeah.
But that's what I would do to fix that loan. Is I would cut my compensation, give it back to the client, and then we could also, if we have realtors in the transaction and we want to save it, maybe our realtor will give up 1% and take 2% instead. So we got options there on finagling it to make it work.
If you want to explore more specifically with Jordan, Ellen, his contact information is there. I know
that was probably like eyes.
We're going to come in for a landing here because we've been
Yeah.
going for an hour. I'm in doing so. I want to do this. Number one, I want to let you know that we'll get the replay later tonight or tomorrow. If you want to go back through this, any of this, we'll have it there. You can create a free account at wakeup.realestate for marketing resources and scripts and templates. Check out vqualifier.com for how we are collaborating with agents to help them increase their conversion ratio and thereby increase their GCI. Jordan's contact information is in the chat, or if you're watching this on replay, is below. And the last thing I'm going to share is my initial experience with Jordan, way before I was ever part of the Virtual Mortgage Partners team here, before it even existed, to be honest. Jordan saved through the kind of logical problem solving that he just went through. He saved 3 transaction sides. Actually, four transaction sides. Not all were my transaction sides, but he saved 4 transaction sides through this creative problem solving approach of how to maneuver and navigate guidelines, finances, fees, and how to structure deals so that they could be either facilitated or saved, right? So that they could either be made to work in the first place or were falling apart and stepping in. And in one of the scenarios, actually saving the borrower and seller of one of the properties from breaking the law, essentially.
We talked to her. I actually talked to her yesterday too.
Yeah,
absolutely. I talked to her. She called me and asked me some questions.
Yeah.
So
that's my own personal experience and part of what led me to now being partnered with Jordan at the Virtual Mortgage Partners team, because this piece of the puzzle is so critical if you want to succeed as an agent. The ability to make to do more than just the cookie cutter perfect fit in a box deals, especially in a market like this where there are just fewer transactions to be had, there's less inventory, etc., is critical to survive and thrive. So thank you all. Long session, great session. We will have another free info session next week. I don't even remember. We'll let everybody know. I had some ideas for it. We'll let everybody know later this week or early next what that topic will be. If there's anything we can do for you, please don't hesitate to ask. We're here to help and support any way we can. Thank you, Jordan, and thank you all for spending some time here on a Wednesday afternoon.
Thanks.